Hey everyone, this is chapter 10 from Trading Price Action Trends, and it's about second entries. I got some comments about sharing the PowerPoint slides, so I'm going to try to put them all together and find a way to make them accessible by downloading them. So I'll need a little time for that, but I'll try to make sure to get that done. Also, thanks for the feedback and comments and stuff. I just haven't had a chance to respond to everything, but I'm glad that you've all found it to be helpful, and I like making them. It also really help solidify the knowledge for myself. So I like making them, and I'm really glad that you all find them helpful. So let's get into chapter 10. So chapter 10 is about second entries. And Al talks about how second entries are more reliable than first entries. And the reason being that a second entry, which means a second attempt by one side, implies that the other side has failed twice. So you're taking a bet that the other side has failed twice. So here we have two legs down, but this is a new leg, it's a new breakout, and it's an attempt to break below the moving average. So the first attempt by the bulls is the first time the market goes above a signal bar. So here we have the breakout below the moving average. The bulls have a first attempt. Now, so far, the bears have only failed once below the moving average. And for higher probability, Al's saying wait for the bears to fail twice, or wait for a second attempt by the bulls. So here the bears have one attempt to accelerate below the moving average. It rallies, so it triggers the buy above 37, which is the bar above the red arrow. Bears get one more bar here, and then we reverse up a second time. So bears fail a second time. Now, we make the assumption that the bears have failed when the second time when the market goes one tick above the signal bar for the second entry. So the second time that it goes above the signal bar is the second entry buy, and it's the bet that the bears have failed for a second time. And so this entry is higher probability than this entry because we now have evidence that the bears have failed twice and the bulls are now making their second attempt to rally. And this is all happening in a bull context. So it's a rally after a gap up, it's a two-legged bull flag, and now the bulls are trying to resume the market after the bears have failed twice below the moving average. And second entries are very important when the momentum is strong. So here we have 4 consecutive bear bars. It's better not to buy the first entry after 4 consecutive bear bars, breaking up below the moving average. So Al says let the first entry form, let it trigger, and then wait for a second entry. Now this one is closing above the moving average. It's good context, so that's a much better buy. Now Al says that when you're waiting for a second entry, you're waiting for more information. So when you wait for the one side to fail twice, you're getting access to more information, and Al says that's not free. You don't get information for free. You have to pay something for it. And so he says second entries often come at a premium. So here you can see that the first entry is down here, but bulls who want higher probability will wait for the bears to fail twice and for the bulls to try to reverse it twice. That's the second attempt, the second entry. And so if you're getting a second entry, if you're getting more information, Al says you should get a worse price. So in this case, you're paying more, so your stop is further, and you're buying higher, so your reward is less. And that's the trade-off that you have to pay when you're getting higher probability. So the idea that second entries come at a premium creates the concept of second entry traps. So if you're getting a better price on your second entry, it can likely become a trap and trap you into the market. So a second entry trap is a second entry that gives you a better price to trap you in. And Al says a good fill is a bad trade. So if you're getting more information with a second entry, so you're seeing one side fail twice, you're getting more information, but you're also getting a better price, you should be wary of that. So you should feel like something's off if the market's giving you a better price. So good fill, bad trade. So here we have an opening range, a trading range on the open, then we get a breakout, and this could also be a wedge. It's not a great shape, but it's one push, two push, and then this is the third push, but we have a surprise bar up. So bears shouldn't take the first entry. They might look at the second entry. So we have one leg, pause, second leg, and the bar below the red arrow is the first entry. The bar below the white arrow is the second entry. But if you just look at this on its own and you use Al's heuristic or rule that second entry traps or second entries at better prices are probably traps, then you might avoid this and not take it, because why is the market giving you more information, showing you the second leg completed, but then also giving you a better price? And so you might avoid that. Here as well, you have a strong breakout and follow through below the moving average, and then you have a potential second entry here. So we have a signal bar 42, and 43 goes above 42. So 42, that first entry is the bar above the red arrow. And then 44, which is the bar above the white arrow, gets triggered on 45. And you could argue that that's a second entry buy. So it's two complex legs down. There's a one, this first leg has two legs down. So one, pullback, two. And now this second leg has two legs, one, pullback, two. And so you buy above there thinking it's a bull flag similar to this one. The difference between this and that is obviously higher time frame context, which we don't have in these pictures. But you also, in this case, have a really strong breakout here that is giving you a second entry at a better price. So why are you getting a better price when you have more information? This is also happening below the moving average, whereas this one closed above the moving average. But this one also is giving you a worse price. So there's a few factors here, but just looking at the idea of second entry traps, when you look at this one, it's giving you a better price and more information. So Al says be wary of it. And here we needed one more leg down before we got the trend resumption rally here. So the reason, the logic behind a second entry trap is that a second entry trap is also a breakout pullback. So here, when we look at this, we can say, well, it's a impulse, pause, second leg, and then a second failure. So we failed the first time here, went below that bar. We got a second leg, and then we went below this bar. So that's the second failure for the bulls. But Al talks about how failures can fail. So this is a breakout, and that bear bar with the white arrow is a second failure. So it's a breakout failure. But a failure can fail, and when a failure fails, it becomes a pullback. So it becomes a breakout pullback. And when we're getting a better price on a second entry, it could become just a breakout pullback. And that's going to depend on leg expectation. It's going to depend on context and many other factors that I'm going to talk about here. So it's important to understand that just because it's going below a bar the second time, it doesn't mean that the overall structure is complete and that it's actually time for a reversal. So we have a good example of that on the weekly chart of the E-mini. So we have a range here, and we have a strong breakout from bar 20 to bar 23. So it's a 5-bar breakout with accelerating bull momentum. And then we get a pullback on 24, a bear bar, first entry sell, and then we get a second entry sell on 26. So now this second entry sell is giving you a better price than the sell below 24. It's giving you smaller risk, so the stop is actually smaller. It's giving you a higher price, so a better price, which gives you more reward, and is giving you technically more information because you've seen the bulls fail twice. So Al would consider this a second entry trap. Why is the market giving you stuff for free? It's giving you more reward, less risk, and higher probability by giving you more information. That's something to be skeptical about. Now, also looking at this is a spike up. We have a pullback. Typically what follows a spike is a channel. And so just as a heuristic or a rule, understanding that second entry traps when you're getting a good fill is probably a bad trade. That's a good thing to think about as a general idea, just something to be aware of. But when you look at the actual dynamics of price, after a spike, we should get a channel of some kind. We should get trend resumption of some kind. We shouldn't expect that every spike is going to end in a reversal just because we get two reversals down. So this second entry sell on 26 can just as easily be interpreted as a breakout pullback for a channel. So spike, pullback on 24, and then breakout 25, pullback 26 for a channel up. So spike and channel, which is what should be expected after a spike of this strength and magnitude. So given the context and the momentum here, this is probably better interpreted as a pullback for a spike and channel or for a second leg up of some kind rather than the end of the spike and a reversal down. So here's another example. Strong spike, 3-bar rally should get some kind of channel or second leg. Now you can argue that the second leg happened right here on bar 9. And then we get a second reversal down, bar 10. So the first entry is the bar below the red arrow. The second entry is the bar below the white arrow. Now it's not a good signal bar, but it's technically a second failure. We have a micro double top and a second failure. But the context and the leg expectation is saying that this is a very strong spike up. It should get some kind of follow through and continuation based on the momentum. So this could be the second leg up and all we get, but in a bull trend with the context and the strength of the spike, it should be expected that it'll have a little bit more push to it. So this second entry, based on the context and the understanding of what their leg expectation is probably not the high. But just using Al's rule, why you're getting a better price and smaller risk because the stop is closer and greater reward to the moving average. Something doesn't seem right here. So even if you don't understand all that about leg expectation, just knowing that you shouldn't be getting a better price is a good heuristic there. And so if you look at this diagram with the legs shown, this impulse had a pullback and then had two legs up, which is expected. Usually the second leg has two parts. So strong spike, pullback, and then two parts. This is usually not all you get, just that one extra leg up. And this is the same picture that I had up here, where this was the second entry. But if you look at with the legs shown, this whole thing acted as one impulse, pullback, and then two parts up. So just expecting that that is all we get is ignoring the fact that this whole thing has a lot of momentum and should act as a spike on its own. Now, another reason that second entries with better prices often are traps is because when you're getting a better price after a second entry, it's often a major trend reversal on a lower time frame. And major trend reversals usually fail and become trading ranges, which then lead to trend resumption. So here, for example, we have a spike up, pullback, and then second entry. Below this white arrow is a second entry, right at the moving average. On the lower time frame, you can see that it's a trading range and a pullback to the moving average, and then a new high, so possible higher high major trend reversal. And we know that after a higher high major trend reversal, after a strong impulse, it's probably going to become a trading range and then get trend resumption. So if you're selling below this signal bar on 31, which is the bar below the white arrow, it's selling below this bear bar here. So on this right side, right below the white arrow, selling below that bear bar is equivalent to selling below the 5-minute signal bar. You're selling right in the middle of a developing trading range because a major trend reversal usually becomes a trading range. This is also a possible breakout pullback. So in a context where a second leg up is likely, and this is probably not all we get, you're selling low in a possible breakout pullback. So 60% of major trend reversals become trading ranges and get trend resumption, especially when a second leg is likely. So we talked about that a bit here, but usually this one peak above is usually not all the second leg you get. It can be in a trading range in a bear trend, but especially when in a bull context, when a second leg up, a larger second leg up is more likely, this is usually not what you get, just a little peek through. So all these cases, it looks like that one bar is a second leg, but this whole thing becomes a leg on its own that usually gets two parts or a channel or at least some kind of larger second leg up than just one bar. So this one bar becomes part of this leg. That's a good way to think about it. So here you can think about it as big bear breakout and then a small momentum second leg, and then that whole thing becomes a leg on its own because it's so tight and this is so strong. It's probably not just going to get one small peek through the extreme. This whole thing should act as a leg on its own, get a pullback to a double top bear flag here. So 43 and 45 act as a double top bear flag for a more symmetrical second leg. And then you get that rally up to test the extreme. So here's another example of that. Strong breakout above the moving average, small second leg up. So that's a momentum second leg up, but this whole thing will probably act as a spike on its own that will get a second leg up of some kind. And so if you look at the parts drawn, strong breakout, that small leg just becomes a part of this whole leg. So this whole leg gets a second leg up. And so that right there is another sign of a second entry trap. It's giving you a better price, and it's probably just going to become a trading range here for a second leg up. Another example here. So we got a strong rally, wedge bull flag at the moving average, strong spike up, first entry here below 22, second entry here below 25, but it's giving you a better price. And the leg expectation is that we should get a larger second leg up than just this peek through. So we're probably going to get some kind of second leg up or a channel or a leg with two parts. And if I show the breakdown, this whole thing acts as one leg. So what here looks like a second entry sell, this whole piece ends up being one leg and it gets two parts up and then obviously pulls back, gets a trading range, and then gets trend resumption. But just this momentum piece is one spike up, pause, and two more parts. So that sell is not a good sell. It's way too early, even though it's a second entry and you're technically waiting for the first entry to trigger and to get a second entry for higher probability. The context is not conducive, but also the leg expectation is not conducive to that. So here's another example. First entry, second entry, better price. This whole thing acts as one leg, gets a pullback to a double top bear flag, and then gets a larger second leg down, and then one more momentum second leg down. So I'm just going to show a couple more examples of this trap. So really strong spike up, tight trading range, second entry trap. That whole thing, that second entry trap, gets a double bottom bull flag, and then a more meaningful second leg up. So this is equivalent to this. This is probably not all you're going to get. You're not just going to get that peek through. It's going to get a peek through and then some kind of trading range and then a more meaningful second leg up. And that's what I mentioned here, these delayed second legs. That's what I'm referring to, is that it's delayed because it looks like this is the second leg, but it's often a second entry trap. And then the real second leg comes a little bit later. So you can argue that it's one pullback two and this whole thing is one piece. Or how I like to look at it is this whole thing up to the second entry trap is one leg. And then we get a pullback to a double bottom bull flag, and then we get the meaningful second leg or the delayed second leg. And here's another example. So higher low major trend reversal, strong breakout, first entry below the bear bar, second entry below the bull bar, but ends up just being a breakout pullback. Or this whole thing is one leg, pulls back to a double bottom bull flag, and then we get a delayed second leg. So this is the real meaningful second leg. And this one has two parts. So one pullback, and then two is broken into two parts. So I think it's important to note that although second entries often come at a premium, it's not necessary that they do. And this is just an idea, and it's a story to help us remember what to look out for and what to be wary of. But it's not a hard and fast rule. It's not what's actually happening. We don't know for sure that it has to be a bad trade because you're getting a better price. It's just a heuristic and a story that helps you remember what to look out for and potentially keeps you out of bad trades just by knowing that little piece of information. But they're obviously not necessary. You can have a really good second entry sell that's coming at a better price. And so here, for example, we have a trading range day, big down, big up. We have a tight channel, and then we get an acceleration above the channel. And so Al's rule about accelerations above the channel, which is in a climax, is that there's a 60% chance that we'll get at least a small second leg up, but then there's a 60% chance of getting a couple legs sideways to down. So here, the first entry below the red arrow is coming after the first impulse up, but there's a 60% chance that we're going to get a small second leg up from that. So that's not a good entry. Then we get a pullback and a second leg. So that meets the requirement of a structural second leg from this. So it's 2 bars up, pull back to 50%, and then a second leg up. Now this second entry below the white arrow is at a higher price. You're getting a better price, more reward, and higher probability because you saw the second leg. But it's still a very valid sell. It's actually a good sell signal for a swing for a couple legs down. And this is because the structure has changed. Like we've completed the structure, but also because it's not necessary that that the second entry come at a premium. Here, you would consider that, like, why am I getting a better price? Why am I getting more reward after getting more information? But then based on the overall context and the structure of what we're seeing, you can conclude that it's a reasonable swing sell because of the contextual reasons. Same thing here. The first entry is above 30 right here. The second entry is above the white arrow. And Al actually did take this trade. He mentioned that he took this trade. He was scalping before that. If you watch the recording on February 9th, he said he took the buy above 33 with full size. So he's very confident about it. He ended up scalping out because he was disappointed by the tails, but he still took that trade because it's a second entry at the moving average. And yeah, it's giving you a better price, but look at the context. Double bottom bull flag after a gap up and a wedge bull flag here. So 3 pushes down. So be aware that a second entry at a better price could be a trap, but also look at the context and make a decision based on the context. And the second part of that is second entries coming at a premium is not sufficient. So that's, I think, a little bit more obvious, that just because the second entry is coming at a worse price. So here the first entry is below 21, the second entry is below 25, and you're like, well, yeah, we have 2 legs up and now I'm getting a worse price. So that should be a good sell. But again, it's going against the leg expectation that we have a strong break above the moving average. This whole thing might act as one leg, pull back to a double bottom bull flag, as I've been saying this whole time, and then get a delayed second leg, a more meaningful second leg. So just because it's coming at a worse price, the context always wins and the leg expectation always wins. Same with this strong rally. This sell below the white arrow is coming at a worse price than the first one, and it's forcing you to risk more as well. So you think that it becomes a good trade, but it doesn't. It's a strong, tight bull channel. It's not a good sell there. Here we have a second entry buy above 12. It's at a worse price. It's bigger risk, and maybe that means it's better probability. In this case, no, it doesn't. Not just because it's the worst price doesn't make it a good trade. It's coming after a tight channel. It's a tight trading range, and that can often be a double top bear flag before a larger second leg down. So here's another example. Second entry buy, forcing you to buy at a worse price, but tight trading range in a tight bear channel could easily become a bear flag and get trend resumption down, which it did. So I talked about these throughout. You have to understand leg expectations to make a good judgment call. So just because it goes below the prior bar twice doesn't necessarily make it a good sell. It's important to understand structure and leg expectations. And one thing to look out for second entries is the overlap. So here, for example, yes, it's a second entry. And I think I talked about this in one of the earlier chapters where Al talks about overlap, that it's a 2-bar reversal, but there's so much overlap, and an overlap is a tight trading range. And when you have a tight trading range in a tight bear move, it often becomes a tight bear flag that then resumes to the downside. And that's the same as this situation. It's in a tight trading range, lots of overlap. In a tight bear move, it's probably going to become a bear flag and get trend resumption down. And then delayed second legs, I talked about throughout. So this last slide here is just a list of things that Al's mentioned throughout the book and some in this chapter of odds enhancers, something that increases the probability of a second entry working. So the first thing is that it's better if the first entry breaks by more than a couple ticks. So you want to see a strong first breakout above the first entry and then a second entry trigger. The second odds enhancer is it's better if it's an end of structure. So like I mentioned up here, this looks like an end of structure. It's a tight bull channel, climax, pullback, and second leg. It looks like an end of structure based on the context of the day and this tight rally. So it's a better second entry here than, for example, this one, which is happening after the initial spike, which is probably going to be followed by a channel. Third one is that it's better if it's a good signal bar. So ideally, the second entry sell is a strong signal bar based on the signal bars that we've talked about in the prior chapters. And the last one is that it's better if you have minimal overlap, which we talked about in these examples, where when there's a lot of overlap, it's very possibly a tight trading range flag, and it's going to get trend resumption instead of getting a reversal. So I hope that was helpful. A lot of detail in this one, so I hope I explained it properly, and I hope it made sense. Again, if you have any comments, feedback, please let me know, and I'll try to make all the slides for the prior chapters available to download. So thanks for watching. I'm glad you all find it to be useful, and I'll see you in the next one.